Now in this segment, we're going to look at inflation and not just inflation as to what happened in June, but also what is going to happen in July, August, and why we're calling this kind of that perfect panic number. Because when you think about what we've heard, right? Powell has said, look, it's going to be transitory. It's going to increase, a big increase and then drop back down. But we haven't seen that. Instead, we've just seen it remain elevated without seeing this huge blow off, beating estimates by a fairly wide margin, which we'll talk about in a minute, but really not getting to 7-8% or even double digits, but 5.5%, 5.5%, not 4.5, but I think at this point, which is becoming less or is showing to be less transitory and more sticky when you get this replacement value. Now, before we go into some of the details, OPEC, and this could change by the time you see this tomorrow, OPEC is now, UAE and Saudi Arabia are coming close to an agreement saying that it'll increase the amount of supply for the remainder of the agreement because it'll allow the UAE to have a higher baseline. And now apparently Iraq is also seeking a higher OPEC plus production baseline. Not shocking, because if one gets one, everybody should. So that's going to be something to watch. And the only reason I bring that up right now is because obviously energy remains a big part of it. And when we talk about, as we do in segment 2 of the EIA show, gasoline, diesel is obviously a big component of it. But this is a chart that we had back in previous shows, and I just want to highlight where CPI has to be for rest of year if 2021 Q4 inflation is 4%. So when you look at monthly, just look at what the monthly CPI has to be to hit a 2021 4% level. I mean, we are blowing through that number on a monthly basis, which again is just putting us at a level where we're very much going to see this elevated between this backdrop of just inflation that's really running up into 2022. And not to say that it's going to keep going up. And this is where we talk about this pivot into stagnation and this stagflation capacity, which is where we're really starting to look. Because even though home prices have stopped going up, lumber has come back down to some sort of reality, but rents haven't gone up because people have contracts. When is your rent due? When is the contract up? And that's when you're going to start to see some of these to re-rate higher, which is going to put some of the pressure on or put some of that driving force underneath some of those movements. And economists are adjusting U.S. core PCE price indexes higher. So when you look at where things are going, the July, just July versus the previous, you can see that all of these levels are being pushed higher. Now, it's now been pulled, as you can see, very much into Q1 2022. But now they're saying that it cools off in Q2 of 2022. Well, it was supposed to cool off in Q1 of 2022, and now that's going. So again, this is why we continue to see this pushing up, and these will continue to get re-weighted higher. And just look at where we were, and we'll talk about this more in the next segment, but look at the triple R. Like the triple R came in at the second highest level ever at about $860 billion. So we're just constantly putting money into a system that clearly doesn't need it. So what are we really achieving? Like, what is the underlying goal on how we're trying to do this? So July 14th, $860 billion going into the reverse repo. But yet we're still, Powell's sitting there saying that we're still going to be buying bonds. Why? Where's the liquidity going? Why do we need liquidity? These banks are telling you, and financial institutions are telling you, we're tapped out. As we said in segment 1, CapEx is been cut. Companies are sitting on a lot of cash. Where does that cash go? Goes into money market accounts. And then it gets invested in the overnight, and banks are like, look, guys, we have nowhere to put this. So the Fed's like just waving it in, but this isn't permanently leaving the system. It comes back in because my savings, my checking account, a company's money market account is a liability to a bank. They have to give that money back, so it comes back into the market, which is why we're going to continue to see this liquidity become a problem, and we're just adding to it by every month buying more and more bonds. So then when we think about what this looks like, seasonally adjusted. So this is looking at seasonally adjusted. And then when you look at 12 months ended June 2022. So look at all items, right? All items for June, 0.9. Food, 0.8. When food at home, food away from home. And we know food away from home is going up, not down. So that's going to be another one that's going to be one of those movements, because as durable goods come down, services is going to be the next step up. So energy services, which we know has been elevated, will remain elevated in general, but that's not really going to grow too much June into July, July into August. It's kind of at this level. So that will start to pare back, because these are price increases and we're just not seeing those price increases in general. But then when you look at services, less energy, that's where we're going to continue to see. Shelter still is at a very low level, 0.5. Used car trucks up to 10.5, new vehicles at 2. So again, a lot of this is still durable goods. And how many times do people buy cars in a year? It's obviously once. Once every 3 years, if you will, if you're on a lease. So again, that is going to pare back down. So some of the big numbers will come down, but they're going to be supported by things that we buy every day: diapers, deodorant, food, dishwasher soap, detergent. All of these things are not, and they're not going up 1%. It's 9, 10, 15%, which again is something that you buy, week in, week out, month in, month out, which is why we think some of these things are going to continue to be a bigger problem over the coming months. And this is just looking at diapers, just looking at, because we've had Kimberly, we've had Procter & Gamble talk about these price increases and just what they're showing. And they've been saying that by the end of the year, they're going to have raised prices anywhere from 9 to 15%, with a lot of companies talking about really low to mid double-digit increases in pricing. And the problem is this is sticky. This doesn't go away. Labor prices continue to go up. Raw material prices remain elevated, and shipping costs and logistics costs just are through the moon or through the roof, which is going to keep that bid beneath it. And this is just looking at housing, because when you look at this, so the model, inflation excluding vacancy rates, house price, landlord asking rent, USA CPI primary and owner's equivalent rent, which is 42% of CPI, still is at crazy lows in comparison to what the model is indicative of. And it's not, and just look at where things go and how it catches up. Now, it doesn't have to catch up all at once, but it just puts the trend up, which is a huge part of the calculation. So as prices of homes stop going up, it doesn't mean that rents don't stop going up. And realistically, they start going up, because if you buy a house or second home and then you rent it, well, you're going to cover whatever your that house price cost was, and it's going to be at a higher rent, and then you're going to mark to market, and try to get the highest price you possibly can. Again, pushing these prices up and replacing some of the higher items like used cars, durable goods in general. And this is just looking at it a different way. Case-Shiller home price index versus primary rents, owner's equivalent rent. Again, the trend is going in one direction, which is going to put additional pressure on the CPI calc. So what was the CPI calc? Well, June CPI inflation was higher than expected at 5.4% year over year, 0.9% month over month, versus an estimate of 4.9%. So again, almost 50 basis points above where they were expected, and 5% last month. So again, that walk up continues. Now, core was up to 4.5%. Now, core is taking out food and energy. So this is the thing people buy the most of. The core side of things is also accelerating, which is something where when you look at the pace, core had kind of been a little lackluster because a lot of this has been driven by energy. But now we're starting to see that increase because energy prices impact the way companies come up with the price for what they charge for core items. Again, the bigger issue as well. So core was up 4.5%, 0.9% month over month versus a 3.8% in prior months. Headline year over year, now at highest since August 2008. And core Now, I think a bigger component, highest since 1991, just to give you an idea of where we sit in today's world. So then when we look at PPI, this is looking forward. So producer price index, what is the producer price index telling us? June PPI inflation hotter than expected at 7.3% year over year, 1% month over month versus an expected 6.7% estimate and 6.6% in May. Core PPI at 5.6% year over year, also 1% month over month versus an estimate of 5.1% estimate and 4.8% in prior months. This is just what's going to come down to the consumer. So the producer price index, the producer, their prices are going up. So that's their prices charged or their prices paid. So they're going to increase for prices received to offset their increase in cost. This is where the acceleration is going to come. We are not going to see this dip. And this is why we talk so much about PPI, not only internally within the US, but also abroad, because we're importing inflation still. We still have this inflation. Look at shipping rates, container rates. All of these things are coming in at multi-decade highs, which again is just driving up the cost for the underlying consumer. So then when we look at pretty much taking out whatever you want, producer prices, final demand goods, less food and energy, final demand, less food, energy and trade, trying to take out some of the stuff that we're importing. We're at the highest we've been since 2012. And we know it's higher than even going further back. So again, there's a significant problem when we look at what is going to come next over the next 6 months, and it's not going down. It's just as we go from the end of 2021 into 2022, it's going to continue to be elevated, but it's going to be elevated in the sense of a stagnating, stagflation side of the equation, and less about this endless rise, which is possible. We could get a continuous creep of 0.1%, 10 basis points, 20 basis points, depending on how food and some of the other core items dictate or how energy dictates. But right now, the trend is still up. I still think it's going to pause and then essentially go sideways, which will keep us at the stagnating component. Now let's take into account base effect. And then we're going to take out base effect to show just kind of where things still sit. So when we look at the implied base effect, you can see that it's still elevated in terms of where CPI sits, but that's why we're talking about core and what is the projection for the end of the year when we look at consumables and consumer goods. They're still going to go up. So that's why you still see it elevated well into the end of 2021, even as the base effect drops. Yes, you'll have headline pare back a bit, but it's going to be replaced. I still think that it's really the housing that is going to become the biggest backdrop. Now, this is looking at used vehicle value, so you can see that it's finally stopped going up. Hasn't really come down. Now, here's an anecdotal story. So we have a VW Atlas, and we got it in January. And we got a note, a letter, 6 weeks ago saying that they would buy out 6 months remaining on our lease. So clearly we have way more than that. We're not going to do that. Now we just got another notice saying that they will buy out the remainder of the lease and give us $2,500 towards the next vehicle because they're so short. So the question is it going to be for a higher dollar value, lower dollar value? Like, will I reduce my payments? Will I increase my payments? All of these things become important. But again, this is just highlighting just how short that market is. We'll talk about Chinese, automakers. Germany continues to miss estimates because, again, the chip shortage is a problem, not just within the U.S., but in Germany, in China, big hubs of just car manufacturing, which it's not so much that it's going to keep prices going up because this is absurd, but it's just because just look, it goes back to 1995 to give you an idea. It's just that we're not going to come down as quickly, and it's still going to remain elevated, which again is just going to be that overarching issue when we look at consumer price increases going through the remainder of the year. So then when we look at the end to the craziness, so this is auction prices in the advanced 2 months. So this is where, rental fleet buyers facilitating wider margins for retail used auto dealers. This is all going to come back down to earth. It's just going to take another couple months. Now, this could also spike back up. It's just going to be a matter of something to watch to see if it bounces back up. We don't think it bounces up too much, but again, just gives you an idea of kind of where we sit in today's world. So now let's take out the base effect. So this is 6 months annualized. So this is just looking for 2021. Now, given January, February, March has some base effect, I am not saying it doesn't. But when we're trying to just get an idea of where we sit today, you get an idea of where, if we continue things forward going through, this gives you an idea of where we are to close out 2021 at 7.3%. Do I think we get to north of 7% in the end of the year? I'm going to say no. And that's why I think we're at this perfect panic number, because to me, if the higher we get, the more likely it is just going to be this blow off top and then come down. But if we stay at more of a meandering number of 5.5%, that has a little bit more legs. That's easier to maintain if you think of this blow off top and then trying to top that. And that's where we start getting into the stagnation side. And you could see that you had that blow off top in 1980, but it remained elevated. I think this is going to look more like what it did in 1974 through that 1977, where we're just kind of in this range of pain, if you will, instead of this blow off top. And that's going to be some of the capacity that's going to remain in the system. And now looking at it on core, taking out food and energy, this is at 6.17%. Again, not saying that we get to that level, but when you look at core and just look at how core and CPI, ex food and energy, and CPI with all of that included, you can see the volatility. Look at where it is versus where that elevated point was in 2008. So 2008 CPI all items, July 2008 was 6.55%. Core at that period was 3%. So now we're getting this big increase in core CPI, which is why I think there's more stickiness in this going forward. Because again, coming back to what I was talking about in the 70s, you can see that we kind of just hung around this 6 to 7%. So as we sit at about 5%, maybe coming in closer to what looks like August of 1990, and then look at how we just hung around in that level. That's where this is setting up, given what we're seeing on the corporate level, and trying to kind of back out some of some of the base effect. So then when we look at US CPI index, we're running well above where we were on a trend level. And, why do we always need to worry about inflation, and why is inflation always good? But this is what gives you an idea that we are running hot. We're continuing to run hotter, even though the Fed is maintaining, 0% interest rates, or 25 basis point interest rates, and $120 billion of monthly purchases. So then when we look at year-on-year headline CPI inflation, this just gives you an idea of what they're saying is adjusted for base effect. So adjusted for base effect, they have us at 3.5%. Again, it's all about the calculation of what are you taking out, what are you trying to adjust for. But you can see the step movement, 1.7 to 2.1 to 2.6 to 3, 3.5. Again, the perfect panic setup. We're not getting this massive 3 to 6. We're getting 3 to 3.5, 3.5 to 3.9, 3.9 to, and you're seeing how it's more of a gradual movement, which again moves away from this transitory, because transitory is like instant. Like when you look at let's just look at the Texas freeze off. It was a massive hit. We had huge oil builds. We had frac spreads going to zero, but it lasted a week and a half. That's transitory. This is a slow grind. which makes it sticky, which is why when we talk about U.S. oil production, this slow movement that now you start to get this acceleration point, that is what we're seeing here, which is why we remain more concerned. So then when we look at reopening categories, which is another side, because reopening, well, what are some of the reopening categories? When you look at where things sit, used cars, rental cars, insurance, lodging, airfares, a lot of people are starting to do more. But a lot of these companies are still working with less people at lower labor rates, and we're starting to see those increase, which again, that labor increase is going to be that next bump up in some of those pricing. US CPI, all items less food, shelter, energy, and used cars and trucks, still high. Excluding everything you want to exclude, food, fuel, shelter, used cars, trucks, and this is still looks like the worst inflation spike in almost 3 decades. So this is why everybody wants to take stuff out. If we take out all the stuff, all the prices going up, it doesn't look that bad. But just like on Twitter, when I people are like, well, everything you described is cost. I think speaking on the PPI side, yes. How does a company figure out their price? By looking at their costs. If their costs are going from $5 to $10, and they were charging you $6.50 when their costs were $5, and now their costs are $10, where do you think your price is going to go? Are they going to eat the loss, or are you going to get the loss, or the price increase? So again, the fact that people would even say that you're looking at cost and not price is just inherently someone who does not understand the underlying economic backdrop of how this is calculated. We are trying to look forward, not backward, and that's why we continue to see a lot of these pressures. So then when we look at headline PCE inflation, so let's look at trim PCE. I mean, honestly, anything that we're going to show you is going to show just where this is heading in general. So clearly, another move up when you look at the lead in 6 months, which is why we continue to see these pressure points setting up for going higher. So then when we look at selling prices well above historical averages, so higher selling prices. So more small businesses raised prices in June than at any time since 1981 as companies attempt to pass on the cost of rising wages. Those pressures are likely to ease once more Americans re-enter the labor market. We've talked about the labor side. It's been very slow coming back. Job vacancies in June remained close to a series high and led to a record 39% of small business raising pay to attract workers. Higher pay, higher prices. 26% plan to boost compensation in the next 3 months. So again, looking forward, the next 3 months, we're going to continue to see those increases. Those higher labor costs are being passed on to customers by increasing selling price. A net 47% of small businesses said they raised selling prices in June, the highest reading since January 1981, and up from 40% in May. So we, again, keep ratcheting it up. Still, the overall business confidence index rose by more than expected, climbing 2.9 points to 102.5, which reflects growing optimism as the economy reopens despite labor shortages. So unfilled positions at records, higher selling prices at records, plans of firms planning to hire remains low. They're trying to do more with less because they're having to pay people more. So they're trying to compensate by giving those people more hours and moving kind of away from having to hire a brand new employee. So then when we look at core inflation running ahead of NFIB prices, and this is where it's a matter of this backdrop and why we continue to see the small businesses continuing to raise prices as not really keeping pace, because you're going to see this net movement as the expectations continue to pull higher. So then when we look at small business optimism, still remains elevated, but then general business conditions still remain under pressure. So small business optimism to 102.5 versus 99.5 estimate. Net percent expecting better economy rose, but still in negative territory. CapEx plans fell, but job anticipation rose. Mixed number, but still a net positive for some of the activity within the market. So then when we look at small business experience of rising prices is back to levels from 1981, gives you an idea of kind of where we sit and how. I don't really know if we continue to go up because it's so high at this point, but I don't see a lot telling me that it's going to go back down. And that's why we continue to see this going sideways, because their prices are going up. So as their prices continue to go up, they're going to continue to pass that on, keeping those prices moving in an upward trajectory. So then when you look at the next 3 months, again, speaking about the same thing, it's going to push up, seeing the same backdrop. But when you look at hiring plans have gone back up. So if you hire more people at a higher wage, you're going to have to increase prices again. And they're trying to adjust that by cutting CapEx. So this is when you start talking about investment, like how much investment is going to be done? Where is the investment? We know it's been done on the IT tech side, automation side, not so much on bricks and mortar. So this is where we see some of these shifts, and that's where we're getting a lot of this money being pushed into the triple R, just because they're just leaving it in money markets, and that's resulting in more of this coming through. So where are businesses concerned? Quality of labor. This is the recurring thing that we continue to hear. Quality of labor continues to deteriorate, or at least not finding the right type of labor, even though there's so many people available. Taxes remains an unknown, given that there's a lot of movements in terms of what those taxes are going to look like, and inflation continues to be a growing issue that they want to address. Now, when you look at small businesses, the labor market remains historically tight. You can see just where it is going back to the 70s. Remains historically tight, which is why we continue to see these price increases, labor cost increases, aka more inflation coming down the level. And then this is looking at higher prices, hiring plans. So record 39% of business owners plan to raise compensation in June. Record 28% plan to increase hiring. 47%, highest since March 1981, saw higher prices. All of that, again, feeds into the different pieces, moving things higher. So then retail sales comparing to recent levels. Well, that people are spending. So as people spend, you're continuing to see more... You're starting to see more hiring because they're seeing people buying. But how is this going to adjust as we see less and less purchases driven by government transfers being reduced? And again, that is going to kind of put some pressure on where that's going to be in the coming months. But when you look at inventory to sales ratios, still at a historic low or near historic lows, which is why we remain price takers and have to just pay whatever price is in the market in order to keep some of this product moving into the system and keeping things fairly moving, which is why when we look at truckload line haul index, you can see that we're still going back to 2010 at these highs, which are not going anywhere. They're going to remain at these levels when you look at the cash truckload line haul, which is something similar that we talked about in the EIA show segment 2. Then when you look at cash expenditure index, new all-time high, all of that moving higher. So even though you're seeing the index of truck haul kind of flatline, prices continue to move up because of truck prices, and I should say trucker rates, because the driver's getting paid more and diesel prices continue to go up. And then lastly, when you look at implied freight rates, based on everything I just said, are exploding higher again, reaching a new high, putting additional pressure, because it means that you're going to have to pay it, which means that you're going to have to increase the prices within your store, which again, increases underlying prices going forward. I know that we said it a lot. I know we went through it often, but again, we just wanted to rehash how this is going to remain a problem going forward. And now in the next segment, we're going to look at rates, how have they responded, and what is going to happen going forward when we look at investment, lending, and banks in general.